So how does elimination of common fund orders change the settlement process?
Right now, about 8 to 10 securities class actions settle each year. To date, only one has gone to trial and lost. During the last few years, common fund orders have facilitated open filings, which in turn permitted the settlement process to evolve to the point where it resembles that in the U.S. Whether that changes in the future, again, depends on whether cases continue to be filed on an open basis. Again, elimination of the common fund orders doesn't necessarily mean we're going to see closed classes.
And how does the settlement process work today, Mike?
An open class action gets filed. It's litigated to the point where the parties either negotiate a resolution or prepare for trial. To assist negotiations, courts set class closure orders. That order includes a deadline for class members to submit claims or be barred from participating in any future settlement or other resolution. The claim forms have come to resemble those in U.S. settlements, requiring only contact information, payment instructions, and trade details. The other terms are already in place by the common fund order. The parties negotiate and settle the case. The law firms and funders handle the settlement administrations. They already have the proof of claims, which were submitted by the class closure deadline. Anyone who hasn't submitted is barred from recovery under the closure order. So the administrations largely involve confirming information. There are loss formulas to calculate individual payouts, followed by distributions. So the process really does resemble that for U.S. securities settlements, except in three ways. Number one, the timing of claim form submission. In the U.S., the parties negotiate, put the money in escrow, collect the claim forms, distribute the money. They model the losses for the absent class members and negotiate against that estimate. In Australia, by contrast, they collect the claim forms first, then the parties negotiate, they put the money in escrow, and they distribute. They know the size of all class member claims going in and don't need to model them out like they do in the U.S. So timing of claim form submission is the first difference. The second is recovery rates, and I think this is because both sides know the class member claim amounts. Negotiations typically result in higher recovery rates in Australia. In the U.S., we have recovery rates that are single-digit percentages. In Australia, the average is around 25% of the gross loss, so bigger recoveries in Australia. Number three, faster payouts. Administrations in Australia don't involve broad claim submissions. They're done before the settlement attempt, not after, and they involve fewer claimants on average, so the distributions can happen a lot more quickly than in the U.S. So all in all, the Australian settlement process is both sensible and in many ways better than that in the U.S.
So with the elimination of common fund orders, how could things change?
If classes are still filed open, the process should seem the same from the investor's perspective. If we return to closed classes, we're going to see fewer settlements and smaller recoveries. Open or closed, settlements are being further threatened by similar challenges to the court's power to order closure and to bar the claims of class members that don't submit. The courts are currently split on whether they have this power. Closure was denied in the Takata Airbags class action, but it was allowed in Treasury Wine. Ironically, the same argument that defeated common fund orders, that they only favored one side, in that case the funder, may spell the demise for closure orders which favor a party, namely the defendant. Given this split, an adverse appeal court decision, like we saw with common fund orders, could imperil future settlements by frustrating the defendant's ability to buy complete peace.
And what else do you see going on in the market, Mike?
Right now, the business community, critics, and politicians are all railing and rallying against funders and class actions generally, and shareholder suits specifically. There are direct attacks on your substantive shareholder rights. Treasurer Frydenberg recently used the COVID pandemic to rewrite the Corporations Act in an attempt to insulate companies from liability for forward-looking statements. Those changes will remain in place for 6 months until November and offer safe harbor by adding a scienter or state of mind requirement for liability. Companies are protected unless they knowingly, recklessly, or negligently disclose wrong information. Investors should be concerned about companies using this temporary safe harbor to try to shield themselves for liability for adverse things unrelated to COVID-19, or freely permitting them to make overly optimistic statements for other purposes like raising capital. However, the practical consequence will likely be limited, as plaintiffs' lawyers typically focus on situations where companies are at least negligent in their disclosures, where internal information contradicts what they say publicly. The direct attacks on funders seem equally politically motivated. The Treasurer says in 3 months funders will be required to hold Australian financial service licenses and comply with the managed investment scheme regime. This followed the AG's announcement of a fourth review of funders and class actions by a parliamentary joint commission. These are just the latest examples of an ongoing campaign to kill the funding industry with licensing requirements and regulation. The most recent investigation follows 3 prior commission reports by the Productivity Commission, the Victorian Law Reform Commission, and the Australian Law Reform Commission that didn't deliver for critics the recommendations that they wanted. The AG rhetoric suggests this latest inquiry again supports seeking support for a predetermined result, a conclusion in search of support that it failed to garner earlier. To a lesser extent, we're seeing direct attacks on lawyer contingency fees, perhaps because they have broader support. Legal contingency fees were endorsed in both the recent Australian and Victorian Law Reform Commission reports and appear to have legislative momentum in Victoria that we talked about earlier. And again, depending on how these last 2 things, funder regulation and contingency fees, play out, there could be a real shift in the near term in case economics from funders to law firms, which, if it happens, would practically guarantee that we stay within the open class action system.
So what does all this mean for corporate accountability?
A legal system provides optimal accountability when meritorious claims get filed, frivolous claims don't, and investors get full compensation for all harm occasioned by corporate wrongdoing. The open class action system goes farthest towards this ideal. If we return to a system of closed classes, we'll move backwards in terms of corporate accountability. We already have a system that does not capture the full harm from corporate wrongdoing. With open classes, we see far less than 100% participation by class members because settlements are based on claims actually submitted rather than on estimates of the losses for all class members as they do in the U.S. The Australian recoveries will never fully compensate for the harm. If we move from open to closed classes, fewer good cases will get filed. Closed classes means more book builds. Cases will be riskier to finance. They'll take longer to launch. Investor participation will drop. More cases will fail, particularly if investor interest gets spread among multiple organizers competing for registrations. Suits will likely be more focused on companies with large institutional holdings, and the system will tend to neglect smaller companies with retail shareholders, which is really the opposite of what it should be. Larger institutionally held companies already have more safeguards in place. In some, closed classes would increase the disparity between harm and compensation.
So as we wrap things up, Mike, what should our listeners take away from today's discussion?
Here are the key takeaways. The elimination of common fund orders is not good for investors. Whether it has a significant negative impact will depend on how the various actors respond. Investors should not see much change if the court or legislative action returns the common fund order or something similar. If funders continue filing open classes, if lawyers file open classes with conditional fees, or if lawyers can charge contingency fees. However, they will see change for the worse if we return to a system of closed classes. Fewer cases will get filed, participation burdens will go up, judges will lose control on fees, fewer cases will settle, and corporate accountability will suffer. Right now, critics are focusing on protecting companies, regulating funders, and heading off contingency fees in the hopes of hampering classes, open or closed. If they succeed, investors will be worse off and corporate accountability will suffer.
Thanks, Mike.